So here's another example. So we used to do a lot of energy spreads. Okay, we trade, gasoline versus WTI, or heating oil versus gasoline, or whatever, or just spreads between WTI, et cetera. But here's just a really good example of how to trade a pairs trade on two different commodities. So here was a going long RBOB and then short crude oil, WTI. So this was on like the 8th of February. And at that point in time, the RBOB gasoline, this is converting RBOB to a price per barrel. At that point, it was $14.60 per barrel over WTI. So right here, okay? So again, momentum, I like to use my momentum indicators, my stock reversal indicator, gave a signal right there. So this is a good example of commodities, RBOB versus gas. So that's 1460 per barrel over right here. But then that spread blew, and at that point right there, on the 26th of April, now the spread, the RBOB was trading at $22.50 per barrel over WTI. All right, so that's that spread blowing out. So that's a increase of 1460 less the 2250. So that had a gain of $7.90 per barrel of gasoline increasing in value over crude. And if you convert that to one futures contract's equivalent to 1,000 barrels, that was a move of $7,900 per one futures contract. So this again, so you do one contract, you would have made 7,900. You did 10, you make 79,000. You can do the math. So that's how hedge funds can make these, hundreds of millions of dollars doing these spreads, and they have a kind of a neutralized systemic risk for overnight risk. So so the whole oil sectors could be going down, but gasoline's going up more so than crude, and they're both going down within that industry sector. So that's just another way to play it. So there's just a lot of different ways that you can do this.